Art, the market just bottoming here in front of you. 10 years, 30 years, the long end really on the move in rates here today, the dollar flying. What do you make of it?
Yeah, it's hard to have any real good context around what's been happening in markets. Clearly, the multiple compression that we've seen started, arguably last November. So that's been an ongoing battle, especially with the growth names. But when you look at the month of April, take last week, the average move in the Nasdaq 100 was 2.5% in either direction. We're seeing now now it's 3% yesterday and 5% today. So this isn't normal activity. But what I will tell you is I think in the lead that you didn't bury is that's what the market's trying to do. It's trying to find the appropriate level to say we've done enough damage to equity valuations with the information that we have right now. So what do we have right now? We know that the Fed is going to have to be aggressive, likely raise rates by 50 basis points 2 more times this year. Then take a look, right? We know China has a lockdown going on that's affecting global demand and certainly supply chains. We don't think that's going to last forever. And we know that on its own accords, there are inflationary pressures that will start coming down, right? The year-over-year numbers in April, May, and June are going to be easier, so headlines get easier. But the normalization of consumption patterns has started to pull down goods pricing. So if you look at any of the folks that reported this week that talk about the consumer, they're consuming fewer goods and more services. That's healthy for inflation too. I think we're in that period right now where we're going to have this volatility, but I think we're a lot closer to the bottom than we are to some top.
That's interesting, Art. So do you think that this is the market's way of voting, that they heard Powell, they understood yesterday's rally for a moment in time, but generally don't believe that the Fed can engineer a soft landing with all that's going on and all of the things that are outside the Fed's control?
Right. It's the things that are outside the Fed's control that are the hardest to try to calculate, right, and triangulate, right? So, we've gone through 10 rate hike cycles, and 7 of those times we ended up in a recession. So, the 7 out of 10 is not a great batting average for the Fed to be facing coming into this. And even a softish landing would be fine, from the places that we're coming from. But I think what the Fed has actually done a very good job of is being transparent. Let us know what they're doing. They're not trying to shock this market. And I think what we have to start doing is finding out how the financial conditions react when we start shrinking that balance sheet starting in June, but actually when we get up to that $95 billion a month and see what the reaction and the financial conditions look like. That may temper how much the Fed has to do on rates.
Talk to us about opportunities, Art. Where do you see them?
I can tell you this. I would tell you that the most oversold sector right now is technology. I mean the technology that actually has earnings, right? And when you look at a multiple for the top 5 names in the S&P 500, they haven't been this low and going back to the great financial crisis. So I think if you look at technology, very oversold, great opportunities here. I think the most overbought right now to a certain extent is energy, right? So the energy equity complex has followed the commodity. It's never really had any drawdown. So if you look at the multiples of the multinationals like Chevron and Exxon, I think their energy is going to be the best performing sector in the S&P 500 this year, full stop. I don't think it gets to 10% of the S&P 500. And I think if you're putting new money to work, that's not where I would go. I'd wait for some drawdowns there. But, I think if you look at the most overbought, the most oversold, tech and energy fall into that category.
All right. So people, they listen to Paul. Now they listen to you. Now they don't know what to think. That's the market. Art, thanks for joining us today.